everybody, and welcome to 2025, obviously. Happy New Year. Happy New Year to you, Jason.
Rog, and likewise, great to be back on the show for another year of talking charts, looking at price action. I'm looking forward to it. It should be fun.
For sure. And it's great to be back. I want to welcome everyone here on the chat once again. Newcomers, obviously. What we do is we go through the charts at the start, as in the Aussie market, the US market, and the Hong Kong market, because that's what we offer at Selfwealth. And of course, for all our people that have been with us for over a year now, or even less time, longer, whatever it is, all our existing viewers, thanks for coming back to us and watching us and starting to watch us again in 2025. Really appreciate your attendance. Hi Steve, hi D Smith, and hello Rose. I spoke to you yesterday, didn't we, Rose? So now I know some of the people here and my regular viewers. It's great to have sort of handles behind names, and then obviously they know what I look like. They know what you look like, Jace, because you're a Motion Trader. Now, for any newcomers to this show, I guess it's nice at the start of the year just to give a little bit of an intro, right? For me, I've worked as a relationship manager at Selfwealth for 3 years now. It'll be just 3 years at the end of this month, actually. So loving my time here. The business itself, obviously, gone through a lot and still going through a lot, right? But it's a great platform to use, very simple, easy to use platform. Obviously, the biggest selling point was the low cost brokerage, $9.50, which was we were the original low cost fixed price broker here in Australia, right? Now there's obviously a few others out there, but so that's me in a nutshell. And I do love technical analysis. I love what we talk about. So we created this show based on the fact that I knew that there was clients in our community that also used technical analysis, and there was nothing really out there for share trading anyway, other than your show, Jay. So this is where you come in, mate. I actually learned a lot of stuff from you, and this is why I hit you up for a show with us, right? So if you want to just give yourself a brief intro for any newbies on the call, that would be great, Jace.
Yeah, look, my background's all to do with trading markets, and I use price action or charts to do that. And I use a rules-based approach to trading. And it's interesting when we think about like how we develop a trading process. And for a lot of people, they don't really have a process as such. It's just about what will I buy and what stocks do I think might go up. But that's not really a process. And the key, which I've learned going over the years, like I've been doing this going back to 1991. I walked into an investment bank dealing room and started to learn from people who were really good at what they did. And what I'd learned was the people who were successful, they had a process, they had a repeatable way of buying and selling and managing risk, and a lot of it was rules based. And so that's what I do. I offer the Motion Trader service, which is a systematic rules-based way to invest in ASX stocks. And what's really interesting is when you do these systematic scans of the market using rules, you can find a whole lot of interesting stocks that otherwise you probably wouldn't have found, stocks outside the ASX 200. And we talk about a lot of those when we get the viewer questions later on. A lot of the viewers are looking outside the ASX 200. And a lot of those stock codes we look at are for stocks which a lot of people would just find a mystery. And this is the beauty of being able to use a chart. You can cover so much more ground than if you're going through balance sheets. Sure, like if you like fundamentals, nothing wrong with using them at all. That can be really good. I think though, if you know your way around a chart, I think that gives you an advantage, particularly in terms of being able to find opportunities, find ideas, and what's going up, what's going down, what's going sideways, know what to look at, what to leave alone. And that's what this show's all about.
Yep, exactly. Well, it was originally just all about education, right? And I think I found the best man, or one of the best men in the business here in Australia to help us out with that. Whilst we don't really touch on fundamental side of the companies and analysis, you can find plenty of that elsewhere. We really wanted to just focus on being able to read the charts, and you can add this to your fundamental analysis as well. Add this as another layer, right? So it was all about education. It was all about helping people in the markets to also to save capital as much as make money, right? To protect their capital as much as make money, and that's why we have systems in place to help people do that and just become a much more refined trader or even investor. All right, so whichever one you'd like to see yourself out there. G'day Lloyd, g'day Jacques, g'day Devenda, g'day Michael, g'day William. All right, so as you all know, we will go through the three markets to start off with. We'll have a general sort of, I've got already a question which we'll touch on, a general question from a previous show. And then, yeah, please send through your tickers and we'll have a look at the charts and we'll see what we think. As usual, we do need to have our wonderful disclaimer. Please, if you could put that up, Jace.
Okay, so everything today, general commentary only, no personal advice is given today. And just quickly putting this up, other important thing to remember is I'm not part of Selfwealth. My business is called Motion Trader. You'll see my details at the top, licensing, etc., general commentary. Below there is the Selfwealth disclaimer, same thing, licensing details, general commentary. Yeah, important to be aware of those things.
Yeah. All right, fantastic. So yeah, welcome to another great year. I hope, anyway. Fingers crossed. There's a lot of turmoil going on in the world, and there's a lot of big news. Obviously, Trump's not yet in power yet, but it seems to have a little bit of an impact at the start. But it's actually starting to turn us. The market's starting to turn around a little bit. Not sure if it's the Christmas hangover, news hangover, Jace. But what do you think? How are we looking here in the Aussie markets?
Yeah, well, let's jump into our charts. I get some charts up here on the screen. We can start going through all of this. Let's get rid of that. So I've got the ASX 200 here. We'll kick off with that. And this is shaping up as a very interesting start to the year. So the ASX 200 was up about last year. It was up about, there's our open last year. It's up about 7.5% through to the close of the year. So not what you'd call boom conditions by any stretch, but a healthy return before dividends nonetheless. And the trend last year was clearly upwards. But this year is starting differently. We have what I'd call some cross currents developing, and we can go through some charts today. I'll explain what I mean by that, and I'll also talk about some of the strategies for which can be useful in this type of environment, and also consider how to manage this evolving price action. But first of all, just starting with this chart here of the ASX 200, at this stage, the overall structure remains bullish, and this continues to be an upward trend until there's a clear breakdown. But the upward trend, just in the last month, it is coming under some pressure. So just looking at this, so from the December high, we've got this steep sell-off, steep decline for December high, which broke below the November low. So there's the low from November. December's decline broke below that. So what that did, that ended the sequence that we had of rising lows. And so all the way from the start of the year, there's essentially a period of rising lows. We had this sharp sell-off mid-year, but other than that, it was mostly a period of rising lows. So that sequence, at least from the August low of rising lows, was broken in with that sell-off in December. And that in itself doesn't signal a trend change, but I think what it does signal that buyers are less enthusiastic about stepping up and buying the dip than they had been at some of these previous times. And now we're seeing the rebound off that low. And so far it's struggling to really get a foothold. So for example, we had 5 up days just earlier this month, 5 up days, and then you can see a bit better here. There we go. We've got 5 up days, and then that was all undone in 2 days, just this week. So it's not at this point. It's not really getting a good foothold for a rebound. I think if the ASX 200 can't hold on to these gains and instead starts to fall back, starts to get below the January low, then this chart structure really does start to weaken. If we start getting, this rally starts to fail back below the January low, we start getting this overlapped corrective looking pattern. And what I think that could mean, then we start looking at the possibility of maybe a multi-month consolidation or even a trend change. I think 2 really important levels to keep an eye on is the December high and the December low. One possibility is that the ASX 200 is in the early stage of establishing a large trading range that could spend several months in. And just remember back. We just go back to April. So we had a similar sharp sell-off in April. The market rebounded, but then from there, remember how that played out. Then it was just several months of trading sideways until the market broke to a new high. This time will bring its own unique price action, of course, but this is just one of those types of ways markets can play out, how markets can consolidate. And I think a similar pause in the trend is a real possibility where with how things are shaping up at the start of January. I'll show you why I'm favouring this view. What I want to do here, so this is the ASX 200 market capitalisation index. So the biggest stock has the most influence. The smallest stock out of those 200 has the least influence. What I'm going to do now, I'm going to go to the equal weight. So the biggest stock and the smallest stock have the same weighting and have the same influence. So this is an ASX 200 on an equal weighted basis. And what's different here is that the equal weight hasn't been able to get back above the moving averages. So I'm using a 50-day and a 100-day moving average. There's our December high, there's a sell-off, and the rebound has not been as strong as we've seen in the ASX 200. It's been quite a muted rebound, actually, and it hasn't been able to get back above the 50-day moving average. And it seems to be stalling. It's stalling and consolidating below the moving averages. And as regular viewers will know, we talk about when markets consolidate beneath moving averages, and particularly moving averages which are rolling over or trending down, that's a point of vulnerability. Now, this doesn't mean that prices will fall, but this is how the structure can start shifting from bullish when prices are rising above moving averages to bearish when prices start consolidating and then declining below those falling moving averages. As I say, that hasn't happened yet, but I think we need to be aware that this is how those structural changes can occur. I think this structure look, this is just something at the moment. I think we need to be aware that this potential structural changes is going on. Need to be aware it exists, and I think we need to just monitor how it develops. I'm working on the basis that the overall trend is up until proven otherwise. So just looking at our ASX 200 chart, I'll work on the basis that this is up until proven otherwise. Hasn't been proven to be breaking down yet. We've got warning flags, but at this point it hasn't broken down. But I'm prepared for the uptrend to take some time to consolidate, or I'm also prepared should it turn and break lower. I think the play here is cautiously. I'm not in a hurry to do a lot of buying, but I'm happy to keep holding stocks if they remain in uptrends. And as always, I give my profitable stocks, I give them plenty of room to move around with the aim of seeing off a potential consolidation. So if this goes sideways for a few months, I want to try and stay in my best stock. So that wide trailing stop helps me do that. And and this is a thing, I don't want to sell every time the trend comes into question. So there've been other times over the last 12 months where the trend has come into question. If you're selling every time there's a possibility of a turn, well, then you're always jumping out and it's really hard to stay on a bullish trend. But I know my exit levels and I'm ready to sell if and when necessary.
So when at what point in this market are you going to start getting a bit more negative about it, a bit more bearish?
Well, we've got that December low to keep an eye on. And if prices take out the January low, so for instance, if we see price action which starts to come away again and we see more consolidation down maybe near the December low or slightly below the December low, and these moving averages start to roll, well, then the vulnerability increases. When you get consolidation below the moving averages, you always got to be on guard for then a breakdown from there. So look, that hasn't happened yet, but this is sort of like where I start really getting prepared. I know where my exits are. I don't rush into buying new stocks because I can see the potential for a change in trend. But a potential for a trend change doesn't mean that it's going to happen. There's a potential trend change going on mid-year. It didn't eventuate below the moving averages, and it quickly recovered. We went from DEFCON 5 back to normal operating with the trend returning. So it's be prepared when you see changes in the price action occurring. When the price is below those moving averages, it's structurally weak or weakened, and that's where the bad stuff typically happens on the underside of the moving averages, not on the top side. So that's where I'm watching now. We're watching how this price action evolves. We don't know. Nobody knows. Like, you see all sorts of predictions for what will happen in 2025, but no one should be using the word will happen because nobody knows what will happen. So it's about watching how the price action develops. We want to play offensively when we've got prices rising above rising moving averages. We want to be cautious when we're moving sideways into moving averages because we don't know. Sometimes they can break down, and we want to be defensive when prices are below declining moving averages. Like these periods from past times, below declining moving averages, it's defensive. Above rising moving averages, it's offensive. And sideways, well, we're being conservative until we get breakouts. I think that's the best way we can play it because we can't see the future. We make the plays based on how the price action is setting itself up at the time.
All right, fantastic. All right, is the US market looking similar?
Yeah, well, that's an interesting one as well. So just going over to so we'll start with I've got the S&P 500 here. So I think this is actually really interesting. So the S&P 500, it's just broken down over the last couple of days from this little coiling pattern, which had been forming. So just stepping back a bit, we've got the December high. From the December high, prices came back to the moving averages. We've got the 50-day, the 100-day, moving averages have been rising, and we've got this sideways coiling pattern along the averages. And I actually thought this could have broken up and rallied off the moving averages because that's the path of least resistance in these situations is upwards, but it hasn't. Instead, the last couple of days, it's just broken to the downside. So is this the early stages of a trend change, or is this like a final bit of a sell-off from the December high before the buying comes back in and there's another push to the upside? Just looking at this chart on its own, the uptrend, like I said with the ASX 200, the upward trend still remains intact. You just look at these moving averages; they're still generally pushing the upside. The 50 is starting to plateau, but there's still upward movement in the 100. It's the moving averages are still positive. Prices are still near the moving averages, and the previous time. So just look at the previous times the S&P 500 has been in this position over the last year. And you can see they're back in September, August, back in April, when prices have come back towards that 100-day moving average. The dippers quickly turn into a low and the buyings come in. And I don't think we can rule that out this time either. Like, why is this time any different? Now we can go through some other. I'm going to go through some other things in a moment, but at this point, there's nothing really saying this is that different to what we saw in September. There was I'm sure there was some concerns this September was going to roll over, but it found support and it rallied. That could still happen here. Now, this is the interesting part for me when I look at the S&P 500. So market cap S&P 500 here. So Microsoft, Nvidia, Alphabet, they're the big drivers of this index. But what I like to do, as regular viewers will know, I like to have a look at the equal weight. So rank Nvidia as the same as the 500 stock in the index. And when we do that, the structure changes, and this now looks more like the ASX 200 equal weight, in that prices are consolidating. prices are consolidating below these moving averages. So again, the 50 and the 100-day moving averages. But look at the moving averages this time. Now they're clearly starting to roll over. And as I say, we've got that consolidation beneath the averages. So this is one of those cross currents that I was talking about earlier. And this opens that window of vulnerability that we often speak about when prices are consolidating below moving averages. And something similar is playing out in the Dow. So it doesn't mean prices have to fall, but just means being on guard because the technical structure has now got a clear weakness in it, and the potential is that this could evolve into a larger decline. Doesn't mean it will, but you're more likely to get a decline from this sort of structure than you are when prices are comfortably sitting above moving averages. So this is just one of those times I think we need to be careful. Coming back to the S&P 500, here and now, I think this uptrend, it does remain in place. The trend remains to the upside. I think trying to pick tops is a losing game. There's plenty of reasons to be. People are calling tops all the way up. People have been calling tops all year. In fact, 2024, most analysts thought there was going to be very little. You look at the Wall Street analyst forecast for 2024, and JP Morgan, the biggest bank in the world, was expecting the market to fall last year, and it rose. So the strategists were wrong-footed last year. So trying to pick tops and marks, I think it just doesn't work. Most of the time you get it wrong, and this has been a resilient trend. So I'd rather give it the benefit of the doubt for as long as possible until we get a clear breakdown, which we currently don't have. But we do have some warning flags, and I don't think we should ignore those warning flags. So for me, this means staying long the market. So I want to continue owning stocks, but I want to be reducing some risk. And what I'm doing, I'm not rushing to replace stocks that in my portfolio that hit their exit points and I sell. I'm not rushing to get that money back into the market. I'm happy to hold some extra cash. I've also scaled back some ETF positions, but I'm still net long the market. I'm just not as long as I was when prices were pushing higher above these rising moving averages. As I say, I want to give the underlying trend the benefit of the doubt, but I'm very aware that there's deterioration in the market's underlying health, particularly when we look at something like the equal weight. And I think we need to take some extra caution, and that's okay. Sometimes we just need to like throttle back, be a little bit more conservative. I'm doing this by using trailing stops. I was talking about those earlier. On my profitable trades, cautious with the buying and only considering the strongest setups for getting new money into the market and holding that extra cash until we get some clearer signs that the trend is resuming. Hopefully, we get those signs in the time moving forward. But while there's those warning flags, I'm happy just to power back and watch how the price action develops.
Yeah. Maybe you can answer this question later when we go through the tickers, but obviously, and I'm in a similar position where you're a bit more hesitant to get into any of the regular setups, so you would have been happy to hold cash at the moment while the market's in this phase here. But what would constitute a really strong setup for you to get into it right now? Is it an easy question or better for?
Yeah, look, it's the same sort of price action that I'm often looking at. It's like where prices move sideways. Prices might be moving sideways into rising moving averages, and we get a breakout. I think they're the best setups. And like as you see, the best setups don't always lead to profitable outcomes. This one failed. We've got a false break, and the false breaks are going to be more likely when you've got cross currents and inconsistent conditions in the underlying market. But if I'm going to play, I want to play strong setups where I've got a breakout after a period of consolidation, and prices are just starting to lift off moving averages. Now this could be a basing structure, or it could be a continuation pattern. So I'd call this a continuation. So we've had a market which had been rising, and then it's gone sideways, and then it breaks out again. So that's a continuation, as opposed to look, I don't have a quick example here, as opposed to when you've got like a market which has been bombed out for a stock maybe which has been bombed out for 12 months or so, and it's established a big base, and then it starts to break higher. So you can have different types of breakouts, but at this point, I want to play breakouts where stocks aren't stretched, where I think they're asymmetric situations where my downside looks relatively small compared to my possible upside. But I think there are fewer situations where we're getting stocks breaking out of consolidation at the moment when you've got prices generally pulling back. So, and I've seen this through my Motion Trader service over the last month. There really has been few initial buy signals since maybe mid-December. And people sometimes get frustrated. They join a service like Motion Trader because they want buy signals. And then I send out no signals for today. And they go, well, I want signals. But my job isn't to create entertainment. It's to help people build wealth through their portfolio. And if the setups aren't there, I don't play. I don't operate on a quota system. It's not like I think I've got to provide 2 buy recommendations a week or 3 a month, whatever that may be. If there's no signals for 2 months, there's no signals, and there's no apologies for that. It's not, it's not a quota service. It's a money-making service. We want to look for opportunities that stack up, and when they don't stack up, don't play. That's our advantage as retail, as private traders. We can choose when not to play. Whereas if you're working at an investment bank, there's a expectation that you're going to make something happen. And I know because I've been on that side of the desk. You can't sit there and take no trades for a month without someone looking, going, well, you're going to do something. When you're a private trader, you can do that. If it's not set up right, just sit and wait. And being patient is such a valuable emotional state to have as a trader or an investor. Being able to just say, look, it's not working at the moment, not working for me. I'll wait. I don't need to do something. And the need for activity is often the precursor to losing money. So only play when you think the odds are in your favour, and take a seat in the grandstand when they're not.
Yeah, I think that's a lesson that I'm having to learn over and over and over again, but I'm getting better at it. But sometimes sitting on your hands is the best action you can take, right? So especially in these times. All right, let's have a look at the Hong Kong market then.
Yeah, just quickly whip through this. I think this is just a market to avoid still. The rallies are continuing to be sold. Look at this nice rally we had in towards mid-December. It just couldn't hold those gains at all. It just quickly came back to where it all started. Prices are yet to stabilise and find a lasting low, with a new low going down yesterday. And just look at look at how we've got this. We just still got this sequence of lower highs. So it's just not set up to rally or rally in a sustainable way at the moment, until we see these dips starting to be supported. What we really want to see is when we get a strong rally, you want the dips from the rallies being supported. That's a sign that there's buying interest coming in underneath the market, trying to accumulate stocks on the dip to get ready for the next leg. But instead, what we're seeing the rallies, and we're seeing the sellers start lining up to want to start unloading stocks. So it's the opposite to what we want. Until we see those dips supported, I just don't think there's in a hurry to be much. What we need to see this sequence of lower highs broken, and for the market then to be able to consolidate above these lower highs and start getting some upward momentum. Same goes when we look at the Chinese market. This could all be, and same for the Hang Seng. This could all be part of an ongoing basing structure. There's certainly potential for this to turn into something bullish, but it's just not there at the moment. And like I was saying earlier, until the setup's there, there's just no need to play. We can just check in on this every week or two. Has anything changed? No. This shouldn't change overnight. Occasionally you get these like, this is really news based. This strong rally. Big rallies usually don't just come out of the blue overnight. It takes time to turn these around. It's turning the super tank around. It takes time. So we can just periodically check in on this, see, are we forming up a base? Are we not? And just wait. But I want to see prices rally and then hold their gains and then rally again. That's when we start seeing positive momentum. Until then, yeah, Rog, just not much, I think, to do here.
Yeah, for Hong Kong. All right, let's have a look at the question that came from a viewer a week ago. Sorry, actually last show, and I think it's a good one. So I'm just going to bring it up here quickly, 2 seconds. And it is around holiday times, right? So just wondering what your approach is to stop losses when you're on holidays, Jace. Do you set some triggers to sell to get out automatically, or do you check your portfolio every day, even on holidays, and manage the sells your usual way?
Yeah, look, for me, I check in every day because I'm running the motion trader signals every day, and that's not an onerous task. So I get the end of day data, download that at about 4:30, run it through the system, see if there's any signals for the next day, see which stocks have exited, and if any of my stocks have hit their exit levels, well then I can just place orders maybe for the next day. So that doesn't take me too long. So I'm checking in. I'm checking in daily. I'm not placing live stops for my stock positions. That said, not everyone wants to do that, and that's okay too. It's okay if and sometimes you don't have internet, so you can just place a live stop loss in the market and let your broker look after it. You've got to set the parameters around the stop loss, of course. Either way works. It's finding whatever's going to be best for yourself, for the individual. For me, I'm happy to look at end of day data and take actions accordingly. Others will like to have their live stop in the market. Depends which works for you.
Yeah, and I think like obviously I don't run a service, right? So I had a 2-week break, but every day I would spend just 10 minutes in the morning just looking at my portfolio on the phone and just being able to monitor to see which one of those were getting close to my exit. Luckily, none really were there, right? So, but if they were close to an exit stop, I could put a price notification in to see if I didn't want to use it, the built-in stop loss function, which Selfwealth has, and I wanted to. I just want a notification if it went through the price. I could put that in a system like TradingView, like we've got up on the screen here. And if it gets triggered, then I would get that notification, or I could act on that the next day if I had to sell, right? So, and these simple little systems, but that meant for 2 weeks I didn't buy either, right? That was my break. I wasn't looking at any signals. I wasn't looking at any opportunities. It was literally just trying to protect my capital over those 2-week period where it was only like, I don't know, six trading days or 6 or 7 trading days anyway, right? So, but that's the other way you can look at it, right? What we're teaching is we're not spending hours and hours in front of the computer, right? So, both options are great. Maybe don't look at it at all, but then you got to be wary that obviously something could happen in the markets, black swan event that could hurt you, right? So you definitely want to. I think to check in 5-10 minutes a day is kind of a good thing, right? On anything, and it just provides consistency as well. But that was my way of dealing with it over the holidays as well, right? So
I think, Rog, anyone who wants to have an individual share portfolio, I think they do need to have a general awareness of what's going on within that portfolio. Like if you want to hold an ASX 200 ETF, fine, don't look at it for 3 years. That can be okay. It might just be a longer term hold that you hold for 10 years or whatever. But individual stocks are different creatures, and a lot of damage can be done in individual stocks if you turn your back. It's like turning your back on the ocean. You get a big wave and you hit the sand. So you don't want to turn your back on individual stocks. They can move quickly and unexpectedly. It's good to be. I think we need to keep it. It doesn't mean you've got to be watching them every minute of the day by any stretch. You can go a week and don't look at an individual stock if you kind of know where it is when you're going on holidays, if it's got plenty of margin before you think you'd need to do something. But generally, we do want to be checking in on our individual stocks more so than maybe an ETF position.
Yes, exactly. And just another quick one on stops here from Michael. General question around: do you tighten your trailing stops at all in this market? Do you tighten them? You normally use a 10 ATR. Do you?
Yeah, my trailing stops and it's basically the same as, are the same as motion traders trailing stops. So it's 10 ATR, and there's I also, it's a bit of a hybrid between a percentage and an ATR. So I also set a minimum distance of 25%. So that stops the ATR stop coming in too close during periods of quiet consolidation. But no, I don't tighten stops when things get uncertain. And this is why the stops are wide, is to see off periods of uncertainty, because lots of periods of uncertainty lead to ongoing trends. And like if we just go back to the ASX 200, like look at this volatility that we saw over 3 days. If after the second day you said, look, this is looking ugly, I'm going to tighten my stops, maybe all your stocks got stopped out on the final day of the selling. But if you had wide trailing stops, which I do, I can't quite remember, but I may not have even. Look, I think I did sell a handful of stocks during this period, but the vast majority of my portfolio remained intact. Wide trailing stops, I saw off a 3-day decline of 7%, and within a month or so, stocks are back at a new all-time high. So this is why we have a wide stop, to see off volatility. So if we tighten stops when we start experiencing volatility, it kind of defeats the purpose of why it's in place. It's not in place for when the sun's out. It's in place for when the wind picks up and things get a bit hairy. But of course, the cost of that strategy is at some point, a volatile period turns into an ongoing decline. So then you give back more money at some part of the cycle when it actually does turn. But there's we can't have it both ways. We can't stay in big trends for longer, but then get out quickly when the ultimate peak happens, because there's no way to tell a period of volatility from a trend change. Like we can see consolidation below moving averages, and there are red flags, but we can never be sure, particularly at the highs. When we're at a high, we never know, is this it? Or is the next pullback just going to be noise before another high? So it's the wide trailing stop is there to see off volatility, but the cost of that will be at some point you'll give back more from the ultimate high. But for me, I find if I can stay, like I've got stocks, I've been holding stocks over the last year which have rallied 300%, 400%, 500%. If I'm jumping out every time there's a 10% pullback, I'm not going to get that. So I'm happy to give back more at the end for the potential of making a whole lot more in that big middle flight stage.
All right, beautiful. Well, let's start having a look at some of the stocks. We've got a few to get through. So we'll start with NXL from Steve, please.
So this has been one of those ones coming back in the last few days. And so this feeds in nicely what we were just talking about. So the wide trailing stop, actually this hit Motion Trader's stop yesterday. So the wide stop was able to see off this initial fall, giving it a chance to establish a base and regain momentum, but it hasn't done that. It's come down. It's just triggered the Motion Trader stop. Now that doesn't mean that it won't base tomorrow and start going up again. Some stocks do that. They'll trigger a stop and then that'll be near the low and then they'll be up and away again. But the danger lies not in the stocks that rebound after we sell them. It lies in the stocks that continues falling when they trigger stops and we don't sell them. So trailing stop is just there to help manage the potential loss of capital. It's not an indicator itself on the future course of the stock. For me, like I'd be if this was in my portfolio, I'd be following the trailing stop. The price is now below the moving averages. The moving averages are starting to roll, particularly the 50-day. The risk is that we get the risk is that we get price action now, which is like so, where it doesn't rebound quickly. We get that shallow rebound, consolidation below moving averages, and then that creates a vulnerable position where we can get further selling. So that's what I'd now be worried about if I was holding this stock. Now, does someone say, look, I just want to give it a little bit longer? I'll say, look, I just see whether it just wanted to touch below that November low, clear out some stops, and now it's going to rally. So maybe I could give it just a fraction more. But when we say I'm just going to give it a little bit longer, it can become a bit of a slippery slope in that a little bit longer keeps getting extended out. So if I hadn't followed that motion trader stop for whatever reason, I think I would have just followed it. But if I hadn't, I wouldn't be giving it much more runway. My stop would be, I'd lock it in, lock my stop in, go, right, this is my line in the sand. I will not move from it. Because once you start moving that line in the sand, next thing you go, oh, look, I'm just going to move it. I'm just going to move to here. No, I'm going to move to here. No, get one more time to here. And then you say, oh, well, look, it's now fallen too far. I'm just going to long-term hold. You can just see how the situation can unravel. Not to say it's going to happen in this particular stock. I don't know. Maybe this one makes a new high within 2 months. I don't know. But I'm about managing risk. It's about, I'm worried about what I could lose before I'm excited about what I could make. So I will, I'm now in a stock like this, I'm now moving into a defensive position, ready to protect capital.
Very good. Let's have a look at VUL.
Yeah, if I had it, I'd keep holding it. It's a big pullback to the averages, but that can happen. It's a stock which has been in an upward phase. It did get. This is why I don't like buying stocks when they're really stretched above the moving averages, because moving averages are a bit like gravity. They tend to pull the stock back. And at some point, all these stocks come back to their moving averages unless they stop trading for some reason. If they continue trading, they will revisit their moving averages at some point. So it's not it's what I call, it's not an asymmetric entry point once you get into this acceleration phase above the averages. Having come back to the averages, so far they've stabilised and rebounded. I probably wouldn't be giving it much longer. My stop would be just really probably not much below the 100-day moving average. But if it can stabilise here and like you could get a situation where it goes sideways for several months and then starts to go higher again. So I'd be happy to continue to give this the benefit of the doubt at the moment, but I'd have my line in the stand below the 100-day moving average. Motion Trader has a calculated stop. I'm not sure where it is offhand because this is actually a Motion Trader stock, as most stocks and uptrends will be. If a stock is trending above rising moving averages, odds are there's been a Motion Trader signal for it at some point. But I wouldn't be rushing to buy. It's not one of those standout setups that I want to rush into in the current climate. So I'd be happy to hold it if I had it, but I know where my exit is and not rushing to buy at this time.
All right, beautiful. All right, can you touch on, from D. Smith, can you touch on BRN and then CHN? BRN was sold and CHN at the
was that BRN, brain chip?
BRN to start off with, yeah, brain chip.
So yeah, this is an interesting stock. It's a volatile stock at that. It's but it does have the conditions for an uptrend are currently in place. So here's one of these. This is like one of these patterns I was talking about as a setup, which I like. So you can see got the strong rally off the low, the moving averages cross, and then we get the sideways trading into the averages, and then we get a breakout. So that's the sort of breakout which I'm interested in buying, even in the current climate. So it's had a big run from that, and now just like we're looking at it in Vulcan VUL, it's now it accelerated away from the moving averages, not an asymmetric entry point. Sure enough, it's having that pullback to the moving averages. If I had this stock, I'm still happy holding it. So say I bought it on the breakout, I'm happy to risk giving back that initial gain for the potential of staying on what could be a much larger trend. So we don't know whether that larger trend will materialize, but that's how you get the larger trends, by putting yourself in the position to get them by staying on stocks which are structurally set up in a positive way, and that being above rising moving averages. So initial rally, got the pullback. I'm not buying anything like this at the moment in the pullback, but my trailing stop would be just probably below the 100-day moving average. So I'd be risking a moderately profitable trade coming back and trading at a small loss. I'd be happy to do that for the potential of staying on what could become a much larger trend. But look, the odds are always against a stock becoming a 100, 200% plus stock. Most stocks don't do that, but we only need a few of them in our portfolio that do that. If 5% or 10% of the stocks in your portfolio travel triple digits, well, then you've really got the makings of an outperforming portfolio. So I'm happy to risk giving back 20%, 30% gains for the potential of them turning into a 200, 300% gain. So brain chip, I'd be holding it. I'd risk giving back this initial gain, see if it turns into something much bigger.
Good, that's what D. Smith's doing, he's holding. What about CHN, which you just recently sold?
CHN. So that's Chalice, is it? I think this would be an interesting. I haven't seen this for a little bit. Yeah. And look, you can see how the structure has changed. And this is what we were talking about with the ASX. In that, let me just roll this back a little bit. So you can see where the structure changes. So we've got a situation where the price is above moving averages. It's only just been above for a few months, but then it's come back and you get the consolidation below the averages. That's where that vulnerability window opens. And in this case, you can see the vulnerability did lead to downside. Now we're getting more consolidation below declining moving averages. So I think the risk with this stock is to the downside. Like you can also see there is the potential that a base does form around these previous lows, but this is where it gets tricky. Like if you're bought this on the basis that it's breaking out, and now you've seen it roll over, it starts below the moving averages, consolidating below the moving averages. This is what I was saying earlier with what was that stock we were looking at? I've just forgotten its name. Where it was trading high, it had just started to come down. It's like where do you put your stop loss? You're always looking for should I give it a little bit longer? So someone could say, look, it's now so close to support, I'm just going to give it a little bit longer. And you can see how then a loss starts to snowball because you're always giving it more room. Look, a stock like this, I would have exited as it was, at the very least, as it was breaking down from this little consolidation in early December. Below the moving averages, I don't want to play. It's plenty of opportunities where stocks are above moving averages, and not every stock above a moving average will go on to a big win. As you can see with Chalice, it got a bit of a start. It looked interesting. If we were looking at it at this point here, I would have said, look, I'd be happy to let this one run, see where it goes. But didn't go far. It came back down. It's like, okay, that's okay. That one didn't run, so let's just rotate out of that, go back into something else. It's a case of what this is a case of, Rog. It's a case of if you're going to be wrong early and lose a little bit of money. So lose early, lose a little. I think that's the way I like to play this. I don't mind being wrong. You don't want to be wrong, but it's not that big a deal. So lose quickly and lose cheaply. That's the way to play it. And when you win big, and that's the way to win it. A lot of people do it the other way around. They win often but small, and they lose regularly and lose large. And it's probably the way people go to the casino, isn't it? It's so with your stocks, you want to be lose quickly, lose a little. And I think cutting a stock like CHN is how you lose a little. It's not working, move on.
Yeah. All right, let's have a look at SDI, please.
Trend still up, above the moving averages, pulling back to the averages. So if I had this, I'd keep holding it. Nothing here is saying is yelling out it's time to sell. It's been, it looks like, would that be all-time highs? I had to go to a weekly to check that. No, not all-time highs, but that's interesting to look at on this basis as well. So, has this just been, this has been a big, looks like a big holding pattern over the last, well, it goes back quite a way to 2017. You can, I won't, there's different, let me just do it this way. There's different ways you could just draw this in, but there's, I don't know, generally there's, I won't play around with it here because it's not that relevant, but yeah, look, it's there's you can certainly see there's a period of contracting price action or range trading over the last few years. It's broken above these previous highs, so it looks like it's breaking out of some sort of range. I'd definitely want to keep holding this if I had it, but like look at the extent of the gain since June. So it's gone from 73 up to $1.25. So what? No, it might be 70-80% or something. So it's had a big rally. It'd be entirely feasible. This is a weekly chart. Let me just come back to the daily. Like it's had a big rally there. Like, it's a sort of stock you could see, just chop around and not do much for a while. So big rally, you get the big consolidation, continue back a bit more into the moving averages and stabilize and maybe go again. But I'd be inclined to give a stock like this the benefit of the doubt and say, look, I want to see whether this trend can re-engage. It's only just a modest pullback so far. Wide trailing stop below the 100-day moving average, give it lots of room to move. See if it's one of those ones that's going to go from 80% to 200% and beyond. It may not, but it is coming out of that broader range we saw on the weekly chart. Yeah, it's one I'd like to keep in play if I had it.
All right, fantastic. SHA.
What was that? SHA? Yeah, look, uptrend's still in place. Like kind of all the things I was saying just with the last stock, it's uptrend's still in place. It's above the rising moving averages. If I was in it, I'd be letting it run. I'd have my trailing stop below the 100-day moving average. And if it comes back and stops me out, so be it. But it is interesting. It is holding up well despite all the general volatility in the market as well. It's trading at an all-time high, just about. Is it an all-time high? It looks like yesterday it did touch an all-time high. So for me, there'd be no reason to sell this stock. The price action isn't giving me a reason to sell. So I'd be letting it run with a wide stop.
All right. We've got OCL now.
So I've got some of this stock, and I think I was buying it when it was breaking up. Maybe around September, October, somewhere around here. I'm continuing to hold it at this point. It's pulled back to those averages. Like it's getting itself into a. It's starting to move towards a vulnerable position. It's not quite there yet, but it is starting to get below the moving averages. So if we get the price action where it declines a bit more, and then we see this, then it does start going, well, look, is this one going to go, or is it, are we pulling back? At the moment, I'm happy to give it the benefit of the doubt. I don't have my finger on the sell button on this one. My wide trailing stop, I'm not actually sure where that would be just offhand. So I'm giving at least 25%. So my stop would currently be back around probably just below 14. Depending on where I bought it, I'll also have a time exit in play. So if it trades below where I bought the stock, more than 60 days after I bought it, I'll also sell it. So that would depend where I bought. If I bought around $15, it might be coming into the window of my time exit. So if a stock moves into a loss after 60 days from when I bought it, yeah, I'll close it earlier than when it hits, waiting for the trailing stop. But generally at the moment, I'm comfortable holding this one, but I'm watching it. It is one of those ones which is coming back and is coming into that, possibly creating that window of vulnerability. It's not a dip for me to buy at the moment.
All right, FMG, please.
Yeah, it's this is a no at the moment. I can see a bullish potential for it, so I'll show you the bullish potential for this. It's like, is this like where do we do the just create a parallel line that's kind of parallel. Project that down. Yeah, like is this some sort of a downward sloping range which is forming? It hasn't formed up yet, but I'm looking at the strong rally off the low. Then I'm looking at the corrective looking sideways to lower move. So it's a sort of stock which could we could see price action like such. That's possible from this stock. But I don't want to buy it on the basis of that at this point, because the moving averages are still declining and prices below the averages. So look, it's not a setup. I wouldn't go out and buy this. Look, if someone, no, I won't go down that path. But I can see how this could possibly turn into something bullish, but it's not there at the moment. I don't want to play it. I wouldn't be in this stock because this is. If I was in during the rising part, this was more than enough to get me to sell mid last year, and I wouldn't have exposure to stock in this situation. So I'd just be leaving this alone. What would I do if I had this stock at this point? Well, I'd probably say, look, if I'll see whether this structure turns into some sort of a platform of support, but if it breaks down from there, maybe I'd be getting out in the mid 16s. If it breaks the January low, I'd throw my hands in the air and say, look, enough, I'm out. That's how I'd approach it. People with holding things long term who've held it for 10 years, well, that may not be a suitable approach. But I don't have any stocks in my motion trader portfolio which I've been holding for 10 years, so that wouldn't be applicable to me.
All right, bot. Let's have a look at bot. BOT.
Yeah, trends up, rising moving averages. If I had it, I'm holding it. Wide trailing stop, back below the 100-day moving average. It goes to show. This is why I don't want to manage my portfolio based on what the ASX 200 is doing on any given day, because not all stocks are tracking the ASX 200, particularly these some of these small to mid cap stocks, which most people have no idea of. Like, how many people know anything about Bonax Pharmaceuticals? Probably 99% of investors have never heard of it. But look at the great trend which it's produced, and it's an entirely gettable trend because it's like the price action puts a spotlight on it. We've got breakouts above rising moving averages, letting profits run, wide trailing stops. You can get these moves. So the ASX 200 doesn't determine where every stock goes on any given day. Look, I'm happy holding this one if I had it. I don't have it, unfortunately. And you don't need to get everything. You just need to get a few big wins in your portfolio, and there'll be plenty more you won't catch, and that's okay. You don't need everything. But if you got bot, well, if I had bot, I'd be, as I say, I'd be hanging on.
Okay. Next one is LRV. V for vase.
LRV. Look, same things going on here. It continues to trend higher. it's just wondering on the extent of that pullback. Like that was a big pullback there, 45%. It'd be interesting whether an ATR stop would have been able to see that off. Often my trailing stops will be below the 100-day moving average. Let's just see, out of interest, I'm going to put an ATR stop on this, and let's just say we got in as prices were breaking higher. And well, actually, yeah, I've set the default for this. I think I've set the default for this to 10. Inputs and multiplier of 10. So yeah, it's like, someone will look at this and go, this trailing stop is just, really wide. And it's wide because it's calculated based on the stock's average trading ranges. And you look at the trading ranges in this stock, like that's that looks like a 10-cent day, and potential entry point to this stock was 13 cents. So a few months later, it's having a trading range as much as the value of the stock on the back at the hypothetical entry point. So when you get such big trading ranges, you put a multiple on that, and that's how you get these wide trailing stops. But this is why they're necessary if you want to try and stay on these stocks, because just look at the pullback. There's a 45% pullback back to the 100-day moving average. So you often hear me say my stop will typically be below the 100-day moving average. That's why I was interested just to put the ATR on to see whether that was going to be the case, and that would have been. So if I'd bought this stock, which I didn't know it existed, and was too volatile for the motion trader portfolio to go into that. So if I'd bought this and I'd used the wide trailing stop, I could have seen off this 45% pullback to the 100-day moving average. I'd still be in it, and so I would still be in this stock if I had it. My stop would still be below the 100-day moving average, and I'd see where it goes. And by following that approach, it's been possible to ride a stock from, say, 10 cents to 73 cents. That's look at that. It shows what's possible when you have a rules-based approach. There's a 600% gain, which was entirely attainable with a rules-based structured approach to selling. And this is where so many people fall down. They sell on the pullbacks. They're thinking, okay, I give it 10%, I give it 20%. You can't stay in a stock like this for more than a couple of days. It's so volatile. But a calculated stop, look, you can do it. There it is. It's entirely doable. So yeah, something to keep in mind for people when they're buying stocks and they're going through a 15% or 20% pullback. There's a reason we have wide stops to see off those pullbacks. At some point they will trigger and you go, yeah, that's annoying. I just go back 25%. But then you look at, if you do that for long enough and then you look back in your portfolio, go, hey, look, I go back 25%, but my willingness to give back 25, 30% on this other stock led to a 300% gain. So now I understand why I do it. And that's how the big wins can happen.
All right, PPC?
What was that, BPC?
PPC.
PP. Yeah, I've got some of this stock. It's a pretty unexciting sort of stock. It's land holdings and stuff, I think. But look, I've got it. I'm holding it. I've no intention to sell it at this point. It's above rising moving averages. Just had a pullback to the 50-day. It's rebounding off it. Trends in place. Happy to see where it goes. I just really don't think this is a stock which is going to do anything like any fireworks from it. But yeah, you never know. It's a trend, and I think it pays a dividend. And happy to keep holding it. No reason to sell this stock at this point.
All right. Let's have a look at EIQ.
Really interesting. This consolidation, sideways consolidation into the moving averages. So if I had this, say I'd bought it on the maybe on this breakout in September, just all the stuff we've been going through already today. Wide trailing stop. It's come back to the 100-day moving average. My stop's going to be below the 100-day moving average. So is this like a sideways consolidation that's going to resolve to the upside? I always feel the odds favour these sideways consolidations breaking to the upside. I thought that was going to happen in the S&P 500 in the price action we're seeing there, but it didn't. It's broken to the downside, so it doesn't always play out that way. But I think the odds favour the prevailing trend. The prevailing trend is up. That's a path of least resistance. That's why I'd favour this breaking to the top side. It's like, would you? One possibility to consider is like, do you buy the breakout from this pattern if, in fact, it breaks out? And that's one of the setups I'd consider. Low price stock, 22 cents, so it's going to have some risk attached to it. Say you bought the breakout, you're looking at like, maybe a 20 to 30% sort of stop loss on it. But that can be reasonable in the right circumstances. But yeah, I'd be happy to hold this one and see if it breaks to the upside.
All right, we've got two people wanting IPX.
IPX.
Mm-hmm.
Well, it's had this steep rally, and it's gone a long way in a short time. So it's not surprising it's coming back to the averages. I'd probably say the excitement in this stock is over for at least several months. Like, there's quite a bit of technical damage where like it's given back all of this previous rally from December. So we had the consolidation, we had the breakout, an acceleration. Now it's given all that back. It's come back to the moving averages. My feel would be the best case scenario would be that it would start to find some sort of support back near the averages, and it just goes sideways for several months. Like look at like something like we saw back in this period here, back in February, where we'd had like that strong rally, and then it quickly came back to the averages, and it was a case that it needed to do time. Also saw something similar back in 23. Need to take time to consolidate. I think that's the case now. I think if this rally is to continue, and there's no guarantee it does continue, maybe that's the top, and the whole thing's getting ready to break down. But this is why we have that wide trailing stop. So we give the uptrend the benefit of the doubt, see if we can see off consolidation. If the consolidation turns into a structural change where the price gets below the averages and so on, like we've been through today, well, the trailing stop takes you out, but it gives it that chance to stabilize and then break higher again. But I'm not in a hurry to buy it. I'd be happy to hold it and see how it plays out. See if we get something like we've seen before.
All right, KGN.
Well, there's the makings of the building blocks for a trend are in place, where price has gone from below the averages to above. The averages have turned up. We've got the initial rally. We're now getting the pullback to the moving averages. It's like, but will this turn into one of those big trends? It's like we saw, like there was a big share price, 20% decline in Myer yesterday. And this is Kogan's retail as well. It's like, is this one of those sectors which is going to produce a really big trend at the moment? I feel maybe it's not. I don't know that, of course. Anything can happen. The price setup has potential to it. If I had this stock, I'd keep holding it. My stop would be below the 100-day moving average. I'm not buying it here, but if I bought this initial breakout, I'm happy to give back a modest gain and see that turn into a small loss for the potential of it going. It's finding support, trading sideways, and breaking higher again. It couldn't. It's entirely feasible. But I just look at the storyline beside the stock, retail stock. Is this going to be the one? I don't know, but that's, look, I don't get bogged down into the fundamentals of things. It would be. It's probably something in the back of my mind if I was thinking like, is this a setup I want to buy at this point in time, with the markets being what they are? And I'd probably say, look, I don't want to buy this dip. I don't really want to go there at the moment. But if the price stabilised and broke higher and I got a signal for it, I'd probably go with it. As if it was in my portfolio now, I'd be keeping it. I'd have my stop loss. But yeah, I don't know. I'm not sure this is one of those ones we'll be reviewing at the end of the year, with it being up significantly. But I probably shouldn't say that because I don't know. Plenty of things happen that I would have thought, look, I didn't see that happening, and it happens. So this is why it's a rules-based approach where we buy breakouts, let profits run for as long as possible, give them room to move, and then cut them when they're not working. And by doing that and being open-minded, you can get stocks which often people don't consider because they just go, oh, well, look, that can't work for this reason and that reason. Anything can work for any reason. So, look, probably best being open-minded with it and saying the structure's still positive, but just know where the exit level is.
All right. Telstra, TLS.
Yeah, it's the structure here is positive in that it's above the moving averages. We've had a bit of a sideways period. It's starting to break higher again. It's outperforming the ASX 200 over the last couple of months. Look, if I was in Telstra, I'd be happy staying in Telstra. Usual caveats of wide trailing stop. It depends on your reasons to be in there. There'll be people who've held it for a long time for different reasons. But from an active investing perspective, look, I'd be happy to see where this one goes, see if it can keep creeping higher. Some people might notice could that be an inverse head and shoulders? There's the shoulder, there's the head, there's the shoulder. It's just another way of saying that the declining lows has been reversed, and we're starting to getting in early stages of a sequence of rising lows. So the structure's starting to change. It's gone from below moving averages to above. So look, you never know. It's the structure is positive at this point.
All right. What about S32?
Like I've been watching this and stocks like Chalice we looked at earlier, and LYC, those rare earth and green metals stocks. I've been watching them for a while, and I had a position in LYC mid last year somewhere, and it started to break out, and it started to break down again, so I sold it. This is one of those ones which looks like it's been trying to set up for a while but hasn't been able to get going. At the moment, we've got this consolidation below the moving average, which are rolling over. So I wouldn't want to be stepping up and buying it with this structure. It opens the vulnerability that does pull back some more. You can see this pattern I've drawn in at an earlier time. It's not really. The lines don't really work anymore. We've got that ate through it a little bit late last year, so you wouldn't have high confidence in it nudging above it again now. But it still gives a general view that this is it's a tightening range. Maybe what we should be doing. Maybe we should be looking at as a contracting range, like so. Maybe that's more the focus now. So we're really waiting for me, I'd be waiting for the signal, probably breaking above these previous highs as an entry point. It's one which is sort of like out there on the tarmac, but I don't think it's lined up for takeoff yet. It's one to keep watching. And for me, it needs to be on the right side of the moving averages, so above the moving averages, and probably needs to be clearing some previous highs. And then at some point, this could be a great trade. I just don't think we're there at the moment. For me, it's one to keep watching.
Okay, last couple here, WTC.
I'm worrying that it's like these moving averages are really flattening out. So the trend is still up at this point, but it's under pressure. I'd probably be watching the December low, so a break below the December low. So the price action I'd be worried about would be a break of the December low, and then a shallow sort of recovery. And then from there, of course, the moving average is starting to come over the top of it, and then you get the breakdown from there. That's what I'd be watching for. That'd be my concern with this. Now that may not play out, but I'm thinking ahead. Like, how might the price action look? What am I watching for? So I think that's a risk with this stock. But look, if I was in this stock and I'd been holding it since it broke out back early last year, I wouldn't be selling it at this point. I'm happy to let that profit run with the wide trailing stop. That's what's got me to this place in the first place. But that's the price action I'm looking for. I know where my exit level is. I give it the benefit of the doubt here because this could be a compression that resolves to the upside. It's nothing to say that can't happen, but I think there is some pressure in the trend with the way these moving averages are flattening. It's lost that vigorous upward momentum which it had into late last year. One for probably certainly not one I'm buying. I'm holding, but I'm aware where my exits are.
All right, and the last one is TLXX.
Trend is still up. So, nothing for me to do here other than, if I had it, which I don't, would be to hold it. Again, trailing stop below the 100-day moving average, having this consolidation to the top of the average. We could see another period like we saw around the July-August period where you get that sideways to slightly lower consolidation. You see that, the classic zigzag-looking appearance to it. Not to say that's going to happen now, but there could be some more consolidation along the moving averages. But the trend's up. For me, there'd be no reason to be exiting this stock.
All right, fantastic. I think I might. We'll finish up. Apologies if we don't get to everyone's stocks because we're running close to the end of time now as well. I just wanted to ask about Maya, Jace, if that's okay. A few people have mentioned Maya to me yesterday, including my wife, who's in the retail business. He said, "Oh, the price is down. Maybe we should get some." I said, obviously, well, look, let me ask Jason tomorrow and see what he thinks. So what do you think of this one here, Jace?
First of all, this was a motion trader stock. I think the buy signal might have been around mid-year, and initially we got a nice trend in this stock. It hit its trailing stop yesterday with the share price coming back. So it's probably close to break even, a little bit either side. So a modest win has turned into a break even. We've talked about that sort of thing earlier on. That's going to happen. That's okay. You often, it's these things happen in the stock market. It's usually the bad stuff happens when you're below the moving averages. This time, the bad stuff has happened just beneath 12-month highs. But that will happen sometimes. Sometimes companies come out with updates which the market isn't anticipating, and you get these sharp declines. For me, this is not a dip that I want to buy because it's on the wrong side of the moving averages. So dips that I want to buy where the price is above the moving average and it comes back to the averages. Happy to buy the dip. Happy to buy all these dips. These are dips to buy. This is a dip to step aside from for me. I don't want to be involved. I want to see what happens next. So is this a overreaction and the price is quickly back where it came from. I think that's a low odds possibility, but of course that could happen. But I think that's lower odds. I'd like to see what the next consolidation looks like. Like if I really like Myer as a potential buy, I'd wait for the next, see how it consolidates. Like if we see price action, which is like this, which can't really get much going, then I'm going to be worried that the next move is this is going to turn into a downtrend. The moving averages continue to roll and we go into a downtrend. Like, was to say we can't see like what we saw back in 23, where the stock, price action is different, but where the trend continued. We've got a rebound back to the average and the trend continued lower again. So anyone like looking at the recent past thinking, oh, all dips should be bought because the stock always goes back up, well, you end up with a bit of a nasty decline over 6 to 7 months before it finally started to go up. But why get involved when it's falling? I'd rather get involved when it's back above the moving averages. Do something else with my money during this phase, and get involved when there's I think the odds start to move in your favour when it's above the averages and gaining momentum rather than trying to pick a low on the way down. So not interested in buying the low. This is why we use risk management. This is why I always talk about having many relatively small trades in a portfolio. So that could mean 20 stocks in a portfolio. So if Myer's 1/20th of your portfolio, yesterday's 20% decline is a 1% tick lower in your capital, assuming it's like evenly weighted and everything might not be quite so clean cut. But theoretically, if it's 1/20th of your portfolio, a 20% decline is going to be a 1% loss of capital, like big deal. But if it's a one stock portfolio or a two stock portfolio, well, yesterday was a pretty ugly day. So this is why I say, I think part of a good systematic approach to investing in stocks is to spread capital across a portfolio of stocks, be it 20 stocks or 30 stocks or more, whatever you're comfortable with. But the advantage of that is that these surprise events, which do happen in the stock market, this is the risk of being involved in individual stocks. If it's part of an ASX 200 ETF, you wouldn't even know because it's such a tiny portion of it. But yeah, spreading risk, having risk management strategies, and not rushing to buy dips in stocks which are falling. Yes, it could bottom today and it quickly rebounds, but I'm worried about the risk. I'm worried about the risk that it continues to unravel. So I'm thinking about what's my downside before thinking about what's my upside. Think about the risk, then think about the possible reward. And if the two match up, great, you've got an opportunity. But if you're saying, well, I'm not comfortable with that risk, well, then it's reason to stand aside.
All right, perfect. Thank you very much. I can go back with that news now and provide that and deliver it's a no buy for now. All right, so obviously, everyone on this show knows that it's general advice only. It's been wonderful coming back for another show this year, Jace. I've missed it for the last 3 weeks. Do your own research. We don't know your circumstances, obviously, so make sure you make your own decisions, take your own responsibility, obviously. General advice only. We'll be back next week. All right. I'm looking forward to again being back next week. Please like and subscribe and put any comments you like down. Any questions you might want to put them in the comments as well. I will read them, and if there's anything in general, we'll answer them in the next week. Been wonderful being back. Thank you for your help, Jason.
Roger, that's been fun. It's been a terrific first show back. Lots of great stocks to go through and have a look at. And look, I don't know the future. And like you were just saying about doing your own research and stuff, like none of us know the future. But I think we have a good rules-based systematic approach to the market. We don't need to know the future because we know what to do when a stock is rising. We know what to do when a stock is falling. And if you follow consistently a strong rules-based strategy, you take the emotion out. You're not acting emotionally. You're not seeing the ASX down yesterday and panicking and selling everything and then seeing it back up the next day and going, oh, look, I've sold everything at the low. because you're acting consistently based on what the price action is and your rules are telling you should do. So hopefully we can help our viewers like learn these approaches for themselves and become comfortable using them, and being more able to see off volatility in the market.
Exactly, perfect. That's exactly our mission and goal this year. All right, as it has been every other year. All right, thanks everyone. We'll see you all next week. Have a great week ahead. Take care.